Good afternoon, everybody, and welcome from our Ventura studio right across from the beautiful Pacific Ocean here in Ventura, California. All of us at Integrity Wealth Advisors are very happy to have you join us and taking time out of your busy schedules to be with us today. Today is a very special town hall. We're happy to have with us, not in studio, but on Zoom, Michael Grant, manager of the Calamos Phineas Long Short Fund, a position that we've had in the portfolios for many, many years, and very, very excited about and been very, very thrilled to have in the portfolio given its metrics. And we're going to talk about those today. Just to kind of give a quick and short intro for Michael, and then we're going to let him talk a bit here. When you're worried about the market, you call me, and rightly so. When I'm worried about the market, I call Mr. Grant. So that should tell you what I think about him. Michael, welcome. Thank you very much for taking time out of your busy schedule up there in San Francisco to join us today.
Pleasure. Great to see you again, Steve, and the other people on this call.
Absolutely. This should be informative. It'll be about 45 minutes or so. We've got several questions to talk to Michael about. We're going to get, obviously, just kind of as an agenda, we'll get his take on what's going on, what's affecting the fund so far this year, which has been a bit of an off year so far, but that's so far. We'll get his take on the market the remainder of the year, and he's going to talk, of course, now initially about the makeup of the fund. And Michael, could you do that? Could you spend some time right now describing the rationale for a long-short alternative, which this fund is?
Sure. So I've been running this fund since 2002, a little over 20 plus years. And prior to that, I came out of the long-only institutional world. So I was a portfolio manager primarily with Schroders in Hong Kong and London through the 1990s before they sent me to San Francisco in 2000. And I grew up believing in equities as a manager. And one of my learning experiences was watching how I could convince clients of the long-term value of equities, but yet they very often would not achieve the long-term value of being there. And the reason was that when times were good, they believe in equities. But when the equity cycle turns pear-shaped, as we say over in England, they would not behave well. And the attraction of this alternative, really the purpose, is to cut off the downside volatility tails of the equity cycle. Because if I could deliver competitive-like equity returns over the long term, but in a manner that cut off the downside tails, clients were far more likely to live with the equity cycle and therefore achieve the outcomes. And that's really the logic for the alternative. It's a very different approach, which I can expand on if you like, but that in essence is what we're trying to do.
Excellent description. And just to add to that, friends, a good example of what Michael is talking about, and he'll expand on this, I think, in some detail later on in the discussion. But last year, you may remember the tariff tantrum. The S&P 500 went from, I think, a +5 to a -15 in a very short period of time. But this long-short strategy that Michael Grant manages, at its worst, was down 2.5 when the S&P, as I said, was down 15.5 or so. So that's an example of what he's talking about. That allows that kind of prevents that typical investor behavior cycle to get worried and want to pull out. Anything you'd like to add to that?
Well, I think that captures it well. That's what we did in 2008, right? We protected capital in 2008, and then we came back in 2009. I think we were up near 70%.
Yep.
And
absolutely.
In 2020 was a bit trickier because of the COVID cycle. But again, we were up 20%, the market was up 20%. So just because this is an alternative doesn't mean you have to give up the upside. And actually, I believe very strongly to have value over the long term, you must deliver competitive like equity returns.
Absolutely. Yeah.
And then, I can go through a bit of this year.
Let's do that, because we're getting a lot of questions from clients about that.
Okay.
S&P up 10% or so, the fund basically flat. Talk about that. Help them navigate that.
So let's start first with the war, which was completely unexpected, of course. And in an event like that, our primary mandate is to protect the client portfolio. So, for example, through March, our short positions combined with our put options equaled a little more than 100% of the portfolio. And just to clarify for clients, we're long stocks, but we're also short stocks. And the difference between those two is what we call our net equity exposure. When the equity cycle is in gear, we can raise it to plus 80. But when the market's not in gear, we can actually go net short. So as the war was unfolding, we had both feet on the brake. And if in fact nuclear war did emerge, our clients would have been protected because of the combination of those short positions and the put options, which is like insurance. Now, it's very hard to turn on a dime. Now, into April, we suspected that there would be a major de-escalation, and we began to pivot on April 8th by beginning to increase our exposures. Okay. But it's very hard to turn a battleship in a single day.
Right.
The important message is that we had both feet on the brakes, and as it looked like we were stabilizing, we gradually reorientated the portfolio to a more positive equity exposure.
Right.
Now, there's a much broader explanation here, which goes back to what I describe as the twin shocks of 2026. Normally, you get a shock here once every 5 years or 3 years. What's unusual about 26 is that we have two shocks working simultaneously, but in opposing direction. So we have the Iranian oil shock, and then we have the AI mania.
Wow.
And the crucial difference between them is that oil is a negative and global shock, while AI is overwhelmingly a US-centric and positive affair. And the synchronicity of the two is unique, but explains what's going on in the market. Because if you are interest rate sensitive or sensitive to oil prices, so many consumer businesses, transport businesses, housing businesses, retail businesses, you're actually going down through this period.
Yeah.
If you're AI narrative exposed, you're going up. So there's a big dichotomy that's opened up within the market. And your relative positioning is very different between those two baskets. So I'll give you one statistic. We have a term in the market called the breadth of the market. It's how many stocks are participating when the market goes up. And even though this market has gone higher now for the last 2 months, the number of stocks in uptrends is actually good. The number of stocks in downtrends is rising.
Yep.
And to measure this, today's experience is a 1 percentile outcome since 1990.
Wow.
And the consequence is that if you take out the top 10 stocks in the S&P, the rest of the S&P is flat year to date.
So we're right back to that narrative that we've had, really for the most part of the last 3 or 4 years. It's just really amazing. That's astounding.
and to a degree more extreme. Now, you might say, why is that a problem? Why don't you just own the best 10 stocks? And one of the other aspects of our mandates is we do run diversified portfolios. We're not taking unusually large bets, and we're not benchmarking either the long book or the short book to a particular benchmark. So this kind of environment is very unusual historically, and it is a challenge given the structure of our strategy.
Yeah. So let me ask you a question then. Would you then attribute that lack of breadth then to, say, what's going on with the worries about inflation expectations, the price of oil, the war all by itself? Because, we seem to be getting pretty darn good economic data, seemingly on a daily basis here over the last couple of weeks. What say you on that?
Well, there's no question this is still a very positive macro setting.
Okay.
And the US economy, the private sector, is probably in the best shape it's been in 50 years.
Wow.
And I do not believe there is macro risk for the US economy today.
Excellent. That's good to hear.
Now, one of the reasons for that, but not the whole story, of course, is the AI narrative, which is historic and really extraordinary when you look at the actual spending numbers. But most of the time in the past, when we've had an oil shock, we've gone into recession. But in all those other instances, when we had the oil shock, earnings were going down and the Fed was tightening. And today, in contrast, earnings broadly are going up. And I don't think we're going to get a Fed tightening, regardless of what some of the market participants think.
Oh, that's good to hear. Absolutely. That's fantastic. Well, then in this case, and I know you have a crystal ball in front of you, I hope. What is your thinking then? Given that we're basically 5 months into this year, it's been crazy. It's been uneven. We've had these shocks that you've talked about. How do you see this playing out the rest of the year, Michael?
So I don't see a big macro risk. I think we're in a very unusual period historically where there are multiple sources of reflation supporting the economic outlook. I think the risk to the market is internal. And it goes back to this extraordinary dependence on the AI narrative and a particular momentum-driven theme that has been driving the upside in the market. Now, there are a number of risks here. One is clearly that it's very sensitive to rising capital expenditures on AI, on the CapEx side, right? And the next data point here will come out in July. But there's another problem which is emerging. I don't think AI demand is at risk. I think this is a true transformation. The companies driving it have the revenues and the cash flows for now to continue.
Makes sense.
The problem is that this is a real world, physical world build out. This is very different from historical technology cycles, which were software led. When you have a software led tech cycle, you never have a problem with supply because software is digital. You can replicate it. This is very different. This is a build out now that's happening in the physical world.
You're talking about the data centers.
I'm talking about everything, the data centers, the energy, the power plants, the copper.
Makes sense.
The cooling.
Okay, that's a great observation. Yeah, that's very interesting.
We're already seeing shortages emerge in a whole number of places, even though we're probably not more than 50% of the way through this build out. And I think the narrative for technology in the second half of this year will be the problems on the supply side. Because cost inflation is emerging everywhere in the technology world. I mean, people can see that when they follow DRAM and memory prices. Cost inflation means delays in build-out. Delays in build-out mean delays in revenue recognition. So the issue for many of these stocks is not going to be demand, it's going to be on margins and earnings expectations. And I think that's the story that is going to emerge very, very shortly. Let me make one more important point. Everyone on this call understands AI and how often we use it. But all the winners of AI today are what I call the picks and shovels. They're the AI infrastructure. So that $1 trillion forecast for spending next year is still spending on the infrastructure. And what nobody has figured out is where the revenues and the timing of the revenues to support that infrastructure. Okay, so that is still an important metric that we have to make work somehow. So going back to your central point, how do I think the market plays out? First, I think when the momentum in the AI narrative finally peaks, and my guess is this month of June, the market will actually broaden. So in March of 2000, at the peak of the dot-com bubble, the last 9 months of that bull market were driven by a smaller and smaller group of tech stocks. And when that thematic peaked and the S&P peaked, the market actually broadened underneath. In other words, the average stock actually started to perform better from March of 2000 onward because we were nowhere near recession. Right. So, and Steve, if you can bear with me, and I'll throw one more important idea into this mix.
Absolutely. Yeah.
The real driver of everything that's going on in the US economy is what we call a productivity shock. And what I mean by this is that we're growing and we're creating more output, but we're not growing the number of workers. Right. Each worker is creating more output. So in the last 3 years, the unemployment rate has actually risen slightly, yet the GDP has performed better than consensus. And that's the classic or textbook signature of a supply-driven productivity shock. And the reason I mention this is because there is a risk in the midterms that politics turns against AI and the data center build out.
Ah, interesting. Yes.
And in a typical midterm year, which is what we're in this year, the market historically from March or April through October has one of its roughest periods within the 4-year election cycle. So far, the AI narrative has been dominant. But I think sometime from July into October, we are going to get a correction in equities because those midterm elections are actually very important for US policy vis-a-vis the economy. And that includes the AI narrative.
Absolutely, it does. Yes. And we know there is politics involved there, regardless of what side of the line you're on. AI is a very, very, very hot topic politically. One side loves it, the other side not so much. And so therein lies the risk. Yeah. So we do appreciate you pointing that out to us. So, but I mean, if your context here is a broadening out, is that because, I mean, obviously that's a good thing. We both agree. I think everyone would agree that's healthy to have a broad, market advance. It sounds like that's something that's justified based upon your discussion. No worry about the macro. The economy is strong. You have this productivity boom, really, that we haven't had in a long time.
Hmm.
I mean, those should all be, after we get through this rough patch that you're talking about, doesn't that kind of portend pretty well for the next year or two?
Well, it does. And let me throw a couple other forecasts into the mix. I think, first of all, oil prices are going to be back below $70 before the elections.
Really?
Okay? Yeah.
Now that
And
I would say you're in the minority there, Michael, but we're all ears.
okay. Well, we can all see what's going on with the Iranian situation.
Yeah.
But the important point is that there is more oil production being produced everywhere today than at any time in the last 10 years. The problem is the bottleneck. The problem is not the actual oil that's being pumped out of the ground.
Yeah, it's a good point.
And the world is very rapidly finding ways around the Strait of Hormuz. You look at oil coming now out of Canada, out of the US. Inventories are not as low as many people have feared. In fact, for most fuel distillates, inventories, although they're lower than they were 3 months ago, are still above the March 2024 and March 2025 levels.
Very interesting.
So if we
not something you hear every day on the news, so that is a good sign.
Well, oil markets are extremely complex. They're incredibly large. So I think Trump has many incentives to get that oil price down, and I believe he has the policy levers to do it. So that's an important variable here. Second variable is that normally when you have an oil shock, one of the risks is tightening by the central banks. And we're getting a new Fed chair. We're going to listen to him talk in mid-June. And his priority is to not be another Jerome Powell.
Right.
And therefore, he has a lot of incentives to cut early. And actually, the Federal Reserve has been building the case for cuts, right? They've talked about policy actually being tight.
True.
They've talked about the benefit of productivity from AI. So I think the Fed is actually going to cut at least twice between June and October. So again, hard to see why that would create new stress for the market. So when you put those into the mix, I think the rest of the economy, the rest of the market, in other words, the non-AI portion of the market, is going to perk up. And
beautiful.
There's one other important dynamic here. We are getting the best IPO new equity supply this year in 20 years. Now, it's not a problem in itself, because when you think about it, if SpaceX or Anthropic or OpenAI come to public, the floats are relatively small initially, let's say 70 billion, 100 billion. But the real weight on the equity market is from the lockups of the existing owners of those businesses. And if you make some assumptions about the timing and degree of selling from the former owners, the pre-public owners, you're going to get $500 million of supply coming onto the market this year, and $1 trillion of supply coming on to the market next year. Now, that's going to be entirely technology-focused money. And I think that is part of the reason why the AI narrative is going to run into a bit of a supply problem.
Interesting. Yeah.
And again, I'm hoping that supports a broadening out of the market's performance.
Well, it would certainly be a good breather for AI-driven tech, that's for sure. We've seen some unbelievable gains in certain positions this year, and I think it is time for a rest in that regard. But I'm very interested. You talked about the Fed, in your view, cutting a couple of times. I can't tell you what kind of beautiful music that is to my ears. It certainly isn't the narrative. It certainly is a minority position, but typically that's what works. And it kind of leads into the next question that I wanted to ask you. And this is something that directly affects all of our clients, most of whom have a majority of their money in fixed income or income oriented investments. So what do you see happening in the bond market over the next, say, 1 to 2 years?
So if we go back to 2008, after 2008, everyone in this call had a deep apprehension around deflation. And that
Yes, I remember that.
apprehension
Yep.
hung over us for decades. The apprehension today is the sustainability of the fiscal side here in the United States, where they're running the deficit amidst a strong economy that we've simply never seen before. And we've all seen these figures that government borrowing is now consuming more of the budget than it has at any point in the last 25 years. So the new apprehension relates to the sustainability of this. And this goes directly to your question about interest rates. And is there a point at which bond markets begin to revolt because of the spending that they're seeing on the government side? And my answer is probably not this year. I think what the Fed is going to do, the Fed has too many tools that it can use to keep interest rates under control.
Right.
But ultimately, there is no discipline left in Western societies, either on the monetary side or the fiscal side. Politicians have no appetite for austerity. And this means that this spending is only going to get worse. And this is part of the reason why things like gold, things like silver, have begun to perform in a way that we haven't seen for 30 years. So when we get into 2027 and 2028, then I think we have to be much more sensitive to the interest rate outlook. And I would guess that the problem for financial markets is not first going to come from economic growth. It's going to come from the interest rate side and these fears around reflation.
Got it. So you would then perhaps be fearful of like a 10-year bond going up significantly in yield, potentially?
So the 10-year bond is certainly the right metric. And the conventional thinking is that once it gets much above 5%, then investors will be glued to that daily interest yield. Remember that interest rates today are still below nominal GDP growth. So
would you explain that? Would you explain that for our clients? Not what you just said. That's a great point, but for their benefit, could you explain that? Define that. Thank you.
So the nominal economy, we often talk about real economic growth, but economic growth in nominal terms, which is the real component and the inflation component, it's what everyone in this call actually sees as the world around them, is running 5 to 6% per year here in the United States. Interest rates out through 10 years are all below that level of growth.
Got it.
So this is no different than if your income is going up 6% a year, and the interest on your mortgage is only 4%, that's a fairly comfortable situation for you.
Yep.
It's when those interest rates start to rise, and particularly rise above the level of nominal GDP growth, that they have a contractionary influence on the economy. And there's one thing I want to add here, Steve, which is we have an industrial policy that really began under Trump 1.0, but which has continued, which I'll describe as multifaceted reflation. And the tariff policies are sticks and carrots to bring industry back to the United States to reshore.
Right.
And
Yeah.
that is happening on a very material scale. And this year, you're actually seeing it in the industrial data. So the industrial part of the economy has effectively been in recession for the last 3 years. Entering this year, it looks like it's entering a new expansion, right? And when we talk about productivity, remember what this is. It's somebody building a new plant.
Yep.
Right? So everywhere you look around, you see this language in the papers about this new semiconductor plant here, or an auto plant coming from Europe back to the United States. All of this reinforces the growth story and the productivity story. And it gives me comfort that we could be avoiding recession for the rest of this decade. And the risk to the outlook is the one that you've just implied with your question. How long do interest rates cooperate?
Got it. Okay. Well, that's both optimistic, not potentially having a recession for the rest of the decade, which, again, you think about all of the spending that's going on and the very fact that AI can't build a building. It does take humans, last time I checked. It's, unemployment should remain low and productivity should remain very, very strong. That's a very optimistic outlook. Now, worrisome is somewhat the discussion around the 10-year yield and the potential for this fiscal irresponsibility to result in much higher rates. So why don't you play financial advisor for me here a little bit? I'm going to ask you another question here, because this is really my role, determining how much of a portfolio should be stocks versus bonds. What do you think going forward, given the scenario that you see?
Well, that's the million-dollar question, because what happened in March? We had a crisis and interest rates didn't go down.
Mm-hmm.
We had a crisis and interest rates went up.
Yeah.
Now, for 30 years, it was the opposite. That's why the 60-40 model works so well. If your equities went down, your bonds went up.
Yep.
We are in a new world, a new regime, because inflation is normalized and interest rates will stay higher for longer. And then the question, therefore, is how do you create more of that diversification within your portfolio when you get these shocks? And I think you look at alternatives.
Yeah.
You find alternative products that are uncorrelated to the big swings in financial markets, but can still drive competitive returns. I still think there's a big role for bonds because the return outcome is now competitive, right? Remember, it was only 6 or 7 years ago the rates were at zero.
Right. Exactly.
Okay. So, you want to be there because the returns are there. The question now is how to create more of that ballast in your portfolio.
Absolutely.
And that's why you are, or you certainly have been, looking at alternative types of products.
Absolutely. And yours amongst them is our chief member of our model strategies. And again, friends, I just really encourage you to be patient with this strategy. Let me throw out some numbers to you. Last year, for example, I think, Michael, you started the month off of January up 4 or 5% and then proceeded to lose it, but then wound up the year up 10. This year, it was just 2 weeks into the year. The strategy was up over 4%, almost 4.5%, I believe. And now we're down 1 or 2 or something. I would argue that, yes, the way the sausage may be seemingly to be made might not be so pleasant, but we're in some very unpleasant times with this war and the inflation assumptions and everything else.
Right. Yeah. And remember that correlation feels really good when the uncorrelated nature of the product feels really good when markets go down. But it does imply on a month-to-month basis that you shouldn't assume that our direction is the same as the markets.
Correct.
Because we're not invested in the markets.
Right.
And we had one slide on the long-term performance. So the fund has historically been in the number 1 and number 2 position since inception. Mm-hmm. And the key number is the one on the lower left. This is our net equity exposure. So on average, we've had a net equity exposure of 28%. Now, a long-only fund will be 100% exposed.
Right.
And the point of that figure is to say, by its nature, that implies we will be going left when the market goes right, and at times going right when the market goes left. But if we can ultimately capture more of the upside in the market relative to capturing the downside, the math works out very favorably over any period of time. And as you mentioned, Steve, we have performed in line with the S&P over those 20 plus years, even though we were only invested on average 28%.
That is remarkable. I did look up the math too, everybody. From inception, this fund through yesterday is up 9.52% annual. The S&P, I think, was up 9.7. So, I mean, that's essentially full capture without anywhere near the volatility, which again goes back to one of Michael's, foundational comments that, as a long-only manager, it was great to be in the market if you stayed in the market. The problem is people didn't stay in the market because of the behavior or the fear. And, we talk about that all the time, friends and clients. We talk about that, and that's one of our main roles here is obviously to maintain your positioning in the market. But you have a fund like this, you just never have the volatility of the market. So just an astounding job, Michael. We really appreciate that. Did we have any questions yet, Gavin? Okay, I have a question. It has to do with one of your holdings, and I hope you're allowed to talk about your holdings a little bit. And the only reason I'm asking this question is it has to do with Boeing, and it's because Boeing is in our model portfolio, so our clients are very familiar with it. And one of the reasons for my confidence in Boeing, among many, is that it is in Michael's portfolio. Describe a little bit of your confidence about this particular position, and what do you think might be going on with the share price being so erratic this year?
Well, so there is a long-term shortage of planes that was put in place by a combination of missteps 5 years ago by Boeing, and of course the COVID crisis. And the demand for planes is not going to be the central question, either for Boeing or for Airbus. Yep. It's going to be their ability to deliver. And, I spoke earlier about one of the interesting problems for the AI world. Mm-hmm. We've seen this play out. When there's a supply shock, it can hang over you for a very long time. Now, Boeing has worked its way out of its supply shock, and its recovery and earnings, free cash flows, I think are very well set for the next 3 to 5 years. I saw management actually last week at a conference in New York, and I would say it's all on track.
Beautiful. Excellent.
So I mean, what I would say is that Boeing has been a bit volatile, but actually I would argue Boeing share performance this year is pretty typical of the way stocks normally perform. Where it gets tricky if you compare Boeing to a semiconductor stock,
of course,
or to the NASDAQ composite, right? Because what has gotten built into those expectations is actually the extraordinary outcome, not
Yes.
what's happening with Boeing shares.
Yeah, exactly. Totally agree. It's a wonderful company. And I think it's also part of your discussion about the market broadening out. When the market finally does broaden out, Boeing will be I think, a beneficiary of that. And, amongst many other very good industrial and other fundamental names. Well, this has been wonderful, Michael. Again, we're right at our time limit here, and I just want to thank you very, very much for taking the time out of your schedule. Any concluding comments that you'd like to make to our friends and clients at all about the fund or the markets? Anything that comes to mind?
Well, my opening comments related to the nature of our mandate and what we're trying to do with the product. And a lot of that reflected how I want to manage my own money. And since I launched this product in 2002, I've had 95% of my own financial capital in this product,
Wow.
which because this is part of the due diligence that you do. It's not necessarily widely known. But that's actually a very important feature for the chief investment officer of a product. And the reason is that there are moments in the financial cycle where the short-term pressures from the market or the client business pressures can be very intense. Mm-hmm. And the key to surviving long-term is to be able to ignore that short-term pressure and look through to the medium-term and longer-term to what you really believe. Yeah. And I found that having my own money at stake was often the critical variable that allowed me to ignore that short-term noise.
Wow, that's fantastic.
And that was what we did at the end of 2008 when we got invested in equities again. Yep. And I look at what's going on in AI. It's truly extraordinary, and yet at the same time, I see a number of risks that I don't think are fully appreciated. Yeah. And with my own money, I would now step away from some of those key risks. And that's exactly what we have been doing for our clients.
Well, I think this is the candor and straightforwardness that I appreciate so much about you, Michael, and our clients surely have, I believe, as a result of this interview. And again, on behalf of all of us here at Integrity Wealth, we appreciate the good work that you're doing and look forward to a very long relationship and positive one, as it has been. So again, thank you so much. Take good care of yourself. We are relying on you.
Yeah, and thank you for your support. And I really appreciate everyone's interest today.
Absolutely. Thank you, Michael. Have a wonderful evening.
Thanks, everyone.
Bye-bye now. It was Michael Grant. Again, I think this is a very rare thing to be able to have this kind of money manager access. Our job is to bring this kind of interview to you occasionally. And I think given all of the hype about all of the IPOs and everything that's going on out there, it's very exciting. And yes, a lot of money has been made, and we've also been trimming. And so it's this prudence that we want to continue to bring. It's this education that we want to continue to bring to the table for you, our valued friends and clients. So until next time, take care of yourself. We'll look forward to a more traditional town hall in the next quarter, where we'll go over the market results, what's been going on, and some financial planning ideas as well. So until then, thank you so much. Don't hesitate to reach out with any questions, follow-up questions. We'll look forward to hearing from you. Have a fantastic evening.